FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's 11/14/18. Well, lots going on in the street. Are we in a recession? Are we heading for a recession? And what is that doing to share prices? And what about rising interest rates? Has the increase come to an end? Are we going to start seeing cuts or at least stable interest rates? All great questions. And if you're interested and want to be part of the show, email us, kl@kerrylutz.com. Well, David Scranton is with us, our good friend, Sound Income Strategies. David, welcome back to the show.
Kerry, it's good to be back.
Hey, so what the heck is going on now? I won't even try to address the political scene. That's outside the ambit of the show. But of course, it has an effect on the economics and on asset values. We can't deny that. Where are we now?
Yeah, and you know, it's funny. The political scene is kind of like the cherry on top of it, I would think. Insofar as you know, the reason the markets took a big jump was, starting back 2 years ago, was really because of anticipation that Trump would get in and do some good things to the economy. And whether some of your listeners love him or some of your listeners hate him, the bottom line is that Wall Street loves him. So clearly, when you give up the House, you lose a little bit of power there and a little bit of ability to get maybe that second round of tax cuts through that he's trying to get through.
Right. So,
but it's just the icing on the cake. That's all it really is. I don't think it's anything more than that. Yeah, at the end of the day, you've got a market that's been going up for almost a decade right now. You've got a market that was forward looking, thinking, geez, tax cuts are really going to help corporate America and corporate bottom lines. And it did. But now the market's looking forward and saying, well, what do you have for us next? And, you know, right now we had a good quarter, a really good quarter with GDP. We had a pretty good quarter with GDP after that. But now, is that going to continue to slide back, as a lot of economists would say? At the same time, you're right. When interest rates go up, that's never good for the stock market because it makes interest-bearing alternatives look better as something other than stocks. So money tends to flow from stocks into interest-bearing alternatives, bonds, and bond-like instruments. So all these things are generally not good. It's kind of like the perfect storm for the stock market. Now, when's the storm coming is the thing that's difficult to really predict. You know, is it here? Is it going to hit us in January? I was reading something just the other day where somebody absolutely was convinced as of January it was going to hit. Well, you know, analysts love making those predictions because if they get lucky and happen to be right, now they look like a hero and everyone remembers. Yeah. But the reality of it is, you know, we don't know. We could have resurgence in the stock market. We could have another 10% jump over the next year as momentum, you know, as things consolidate and the momentum regathers itself. But eventually we do need to have a correction. 10 years without a correction is really, really a long time.
And every day that we go on without a correction makes it more and more dangerous, doesn't it?
Of course. Of course.
Yeah. So what about the economic stats of where we are now? The latest GDP growth was 3.5%. Is that going to start to diminish, or are we going to go higher?
Well, I think that 4% was lofty, although we hit 4.2 there in the second quarter. And I don't think we're going to continue to go higher. You know, the funny thing is we talk about GDP growth. We're talking about change from year to year. I mean, let's not forget that the baseline did move upward. So if the whole baseline for the economy moved up once by 4% and then leveled out, that's still a 4% growth rate one time that's going to maintain into the future. But the markets don't look at that. They want to know what you've done for me lately. You know, have you, is it going to grow 3-4% year over year? And I've got to tell you, that's going to be really, really difficult to maintain, especially when the biggest trigger that caused it was the tax cuts. And the tax cuts caused a one-time jump in corporate profits. And then again, so if you're at a 1.5% growth rate and boom, you get this huge jump, then as soon as that jump's done, you're back to the normal 1.5%, 2% growth rate.
Right.
So that's the issue we're having right now. So it's going to be hard to maintain it. I think we are going to settle back down at least in the 2s in GDP. And that's not a recession. And that's not bad growth for what we've seen over the last 10 years. It's really not. But it's not what we were spoiled with in the 90s and the early 2000s.
Right. Okay. So growth, but not overwhelming growth. And we're going to see what? Just kind of more of the same? I think the biggest risk we have right now, even when you look at everything that's out there, the trade war and the deficit about to jump over $1 billion, and all that stuff. Yeah. Right, $1 trillion. Right.
A trillion, exactly. I'm sorry.
Okay.
I think the biggest risk we really have is of the Fed creating the next recession. The Federal Reserve is in a hurry to raise interest rates. And I think if they keep going down this path, while most of the rest of the world is still being more accommodative, at the end of the day, they're going to create the next recession here in this country. Yeah. So, they've got their agenda and they seem to be stuck on it, but that would be my biggest concern right now.
Interesting. So interest rates could potentially trigger the next recession. What do you think here David, is going on with oil prices? They're they're crashing, faster than Charlie Sheen on a 1 week bender.
Well, the oil prices would be a predictor looking forward of a possible recession, of a reduction of demand. So, we've got enough supply. The Saudis have talked about adjusting supplies accordingly, but they can still pump. They can make money at a lower price than we can. So at the end of the day, if you have more supply and you're projecting a reduced demand, or some economists might be projecting a reduced demand, then the prices are going to come down. And that's just a normal ebb and flow.
Yeah. Okay, so China appears that its economy is rapidly slowing down due to the so-called trade war. I would call it an economic war more than anything, but let's just stick with the terminology, the nomenclature that's currently in vogue, even if it's, in my opinion, inaccurate. Economy slowing down, looks like trouble ahead.
Yeah, and the problem with China is it's really hard to determine based upon their numbers what's live and what's Memorex, as the commercial used to say, what's real and what's not, because their economy has been manipulated in ways, far beyond what ours has for many years.
Hard to believe that it could be more manipulated than ours, right?
Yeah, hard to believe, but absolutely true. And it's funny because the GDP growth rate is still better than ours, although ours seems to be moving forward and theirs is coming backward. So I think the real indicator as to what's going on over there, and the fact that we are, winning, if it's possible to win such a trade or economic war, that we are winning it, is seen in the performance of our stock market versus theirs. Their stock market has taken a real hit, which tells you that investors aren't that confident in their ability to really hold out through this, whereas they're more confident of ours here in the U.S.
Interesting. So yeah, and they don't have the soapbox like we have here. So what's going to happen as a result of that?
What do you mean soapbox? What do you mean by that?
I mean the ability to relieve, stress, political stress through open exchange of ideas, the way the United States does.
Well, in some ways, in some ways, you'd think that would help their stability. I hate to say it, but I believe that in many ways we've shot ourselves in the foot by everything that's being publicized, being tweeted, because it creates a lot more day-to-day volatility in the stock market because people are reacting on all these things that are written, that are driven emotionally.
Right.
When, in theory, at least, they have a lot less of that over there. It shouldn't be as big of an issue.
Yeah.
But right now, markets seem to be liking transparency. So it could just be that transparency is winning out, and they're looking at the markets over there and saying, well, that's very opaque. And since it is opaque, we don't trust it. So it could be working in reverse right now.
Interesting. So you think potentially we've got issues here, and all of the controversy and everything is not helping anything, huh?
It's definitely not. And, like I said, the biggest risk right now, I believe, is the Federal Reserve tightening too quickly, creating the next recession. And remember, what would get an assist on that recession is this thing called, what I like to refer to as the reverse wealth effect. We talk about the wealth effect, how when people go up the risk curve into stocks and riskier assets because the Fed has manipulated interest rates downward over the last several years, their 401ks and portfolios are worth more, so they feel better, so they tend to spend more, and then they actually do stimulate the economy. Well, the opposite is true in reverse. If the stock market starts to drop, people feel poorer. And even though the economy may not be changing, because they feel poorer, they might be less willing psychologically to spend. And therefore, the reverse wealth effect actually creates a recession, just like the wealth effect helped get us out of it, 6-7 years ago. So that was what would get potentially the assist in the Fed's creation of the next recession.
Yeah. So that's interesting. So the reverse wealth effect, and we know that what goes up can easily come down, can it?
FSN Radio. It's all about what's next.
Egypt is on the verge, once again, becoming a world-renowned gold producer. The Golden Age is being rediscovered. For millennia, ancient Egyptian kingdoms prospered from unparalleled riches. Pharaohs built their empires and flaunted their abundant wealth that was made possible by the country's resource-rich gold deposits. Despite this rich history, modern Egypt remains one of the most underdeveloped gold mining countries in the world. Aton Resources is at the center of the modern Egyptian mining world, diligently working both as the only public exploration company in Egypt today and as the advocate for mining reform with the Egyptian government. However, those that arrive early like Aton will reap the best rewards. Aton's discovery of the legendary Lost Mountain of Gold at Radruin and its current aggressive drilling program there could potentially reap those rewards. Aton Resources is focused on its 100% owned Abu Marawat concession in the Arabian-Nubian Shield, located 200 kilometers north of Centamin Sakari's world-class gold mine. Aton possesses first-mover advantage in the underfollowed jurisdiction of Egypt, which is currently undergoing mining reform. To stay on top of Aton's latest drill results and news, go to atonresources.com. Aton trades on the TSX-V under the ticker AAN and on the OTC under the ticker ANLBF.
The Financial Survival Network. It's all about what's next.
Absolutely. And we've seen that just over the last few weeks with all this craziness. It's, in August, everything seemed calm. September, things seemed better than calm. Things were moving up. It seemed like the market was hitting new highs all the time or getting ready to. And then all of a sudden, things change. So it bare minimum right now, I think what that means for, probably a majority of your listeners, unless they have a long time horizon with their investment goals, is to really have one finger on the trigger, is to be very cautious. You're going to be in the market. And I'm not saying you even have to be, because if you're retired, you probably need to be careful how much you have in the market. But if you have a reasonably short time horizon and you do want to be in the market with some of your money, you've got to have one finger on the trigger. You've got to be really, really cautious at a time like this.
Yeah, I see what you mean, for sure. And so caution is the byword, but we could see this market still go up from here, though, couldn't we?
And that's what I said. We could. I mean, I'm not going to be the guy who's trying to make a name for himself saying December is the month that, the sky is going to fall. Because the reality of it is, really, truly, I I was shocked what happened after the election. I was personally surprised with the growth that we had in the markets at that time, just on the results of the election two short years ago. So we're at a point now where, between the ability of the president to jawbone the markets up to a higher level in the economy, and you just don't know what's going to happen. So you could get 6, 12, 18 more strong months before things turn downward. But I know eventually we need to have another recession, another correction in the markets at some point. When is anybody's guess, but we're getting closer. We're definitely getting closer.
Yeah, eventually it's got to happen, right? All booms end with a bust, right?
That's right. And that's my having one finger on the trigger comment and being cautious because, most people I find, most rational people don't want to be involved with things that don't make fundamental sense. You can go to the gym and you can see somebody there that's huge, and the trainer tells you, well, he's huge because he's on anabolic steroids. Yeah. And that doesn't mean that you're going to jump and go on anabolic steroids because it doesn't make fundamental sense. It's got health ramifications and it's not real. As soon as you go off, you lose all that muscle. Well, you have to realize that we've been on economic steroids since 2008, for the most part here in the United States. Yeah. And therefore, it makes a lot that's going on in our markets and the economy also not real. And again, most people say, I don't really want to be involved with something if it's that artificial because I don't know what the reality is. And when you don't know what the reality is, that increases your risk. So that's how I'm looking at the markets right now, as people need to question the extent to which they want to be involved in common stocks and stock-like instruments because right now we really don't know what's real and what's not, what's just a lasting effect from the artificial stimulus that had occurred for many years.
So true. So true. I couldn't have said it better myself. So somebody comes to you today and they got $500,000 in their portfolio. What are you going to tell them to do?
Obviously, it depends upon their goals, their time horizon, and all of that. But, if it's somebody who's near retirement, if they're retired or within 10 years of retirement, we're going to focus heavily on income-generating alternatives. Because if you invest for income, that's the bird in the hand. People forgot in the 80s and 90s, because the best stock market in U.S. history, that return on investment doesn't equal growth. Growth is just one component of return. The other component is income. So for those within 10 years of retirement, I would focus on income-generating investments, which, as you know, would then, take away a lot of that stock market risk. Right. If somebody's got a longer time horizon than that, okay, well then maybe it's okay to have more in equities and common stocks and stock mutual funds. But in that case, we just got to be really careful. We either have to hedge or have one finger on the trigger, as I mentioned a moment ago. Yeah.
So you think in this environment, it's a good time to be selling covered calls?
I love covered calls right now, Kerry. I really do. Yeah. If you think the upside is truncated, the volatility's high, you get more premium for that. Heck, you essentially take a stock portfolio with a 3.5% dividend, which is not a super high dividend portfolio, but it's a moderately high dividend portfolio. And by selling the covered calls, you essentially double the income. So you can essentially get a 7% income stream from common stocks. And right now, I think that's a really good strategy if somebody is going to be in the stock market.
Yes. And I don't know. Do you guys do anything with options other than covered calls or straddles or anything like that?
For us, it's primarily on the covered call side to increase yields. And, as you know, our company's called Sound Income Strategies. So whenever we can pick up the income, that's great. That works. And by the way, if you take a value-oriented stock portfolio and you write covered calls, you essentially start to match the returns over the last 8 years or so of a growth portfolio, but with a lot less risk. Yes. Occasionally, we'll use some options to hedge the downside, but there's really no substitute for hedging the downside by simply staying out of the market altogether when that's the proper thing to do.
Yeah. And hey, nobody knows when this thing is going to turn, and it could have several more years of pretty good performance ahead of it. We just don't know. What I find is the common wisdom, the conventional wisdom, is always wrong, right? Isn't that true?
And that's the thing that's hard to gauge right now, because there have been a lot of people for a long time that have been saying it's overdue, it's overdue, it's overdue. That seems to be the conventional wisdom. So if you're going to take the approach that you're describing, saying, well, gosh, let's do the opposite. Well, then that means you're right. The market could have another 10 or 20% upside, no problem. And that's always the struggle.
Yes. And but then again, we always go back to what the wise, esteemed investor Bernard Baruch said, which was, I got rich letting the other guy make the last 10%, right?
Absolutely. They say
So
pigs get fat and hogs get slaughtered. So, I've always been a fan of leaving a little bit of the gain on the table. If I get in, I never get in right at the bottom. I want to see some good, solid momentum moving upward before my confidence builds. And I'm always the guy who gets out too early. So, you know what? If I've got a solid single, maybe a stretch to a double, guess what? I'll take the single. I'm not going to stretch it.
Yeah. Hey, sure money is better than mad money, right? I mean, it's so true.
Yeah, that's right. Absolutely.
So but
sometimes you try to stretch that single to a double and you get thrown out, and that's just reality. So at the end of the day, and people need to decide how aggressive or conservative they want to be.
Absolutely.
But the worst thing that I see, Kerry, is when people get too close to a goal. They're within that 10 years of retirement, and they still think they should be stretching that single to a double.
Yeah. And
sometimes you just don't have to do that. But if you're hardwired to be that aggressive, it's hard to get that out of somebody. It's
very true.
There's a reason that first base coach is there. He's there to say, okay, stop, just hold up at first. Don't go, because the aggressive athlete is always going to want to stretch that signal to a double, whether it's the right thing or not. And that's the struggle sometimes I see with investors. They've been more aggressive in their younger years. So they want to maintain that aggressive posture because they like it. It's how they're wired. But sometimes people get themselves in trouble by doing that. And this could be one of those times when people are more vulnerable, frankly, because the markets have just about quadrupled in the last 9.5 years. So that's a time when people got rewarded for being more aggressive. And, again, people can easily fall into that trap. So my warning is always, only make sure you take the amount of risk that you can afford to take. If you can't afford the loss, then don't do it.
Hey, and ain't that the truth? I mean, if you learned one thing from history, it's that you learn that we don't learn from history. So now is a great opportunity to learn from history without having to pay for it. And look, it's all about what's next here. We don't know what's going to be next. When you really have no idea, then caution should be your guiding principle for sure. Hey, David, if we want to contact you, want to connect with you on the web, where's the best place to find you these days?
Well, two ways. Number one is our website at soundincomestrategies.com. And the other one is my book. If they want to learn about stock market history, historical trends, they can go to our website for the book, which is returnonprinciple.com. And as you know, principle ends in PLE.
Yes, absolutely. And we're wholehearted supporters of that approach. Hey, any questions or comments, just email us, kl@kerrylutz.com, Twitter feed @KerryLutz, Facebook page is Financial Survival Network. David, I'm sure we'll be talking to you again very soon. Definitely interesting times. Thanks for spending your time with us.
No problem. It's my pleasure. We'll talk to you soon, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.